Thanks to our friends at The Motley Fool for sponsoring this video. Check out the link below, fool.com/the smattering, to get access to the 10 best stocks to buy right now. Devon Energy is getting a lot of interest from investors looking in the oil patch right now, and for good reason. This is one of a handful of large U.S. independent oil producers that has a great position in the Permian Basin and has established a smart way to pay out dividends based on its cash flows that can be affected by the ups and downs of oil and gas prices. But I think there's a lot of people that are looking at their favorite finance website and seeing a yield that might not be what they actually earn because they don't understand how the company pays out investors. I'm Jason Hall. This is The Smattering. I've got Tyler Crow here with me. We're going to talk a little bit about Devon Energy, but we're going to share another oil and gas producer stock that Tyler thinks is a better investment. Hey, Tyler, let's talk about Devon first of all. What's your take on Devon?
Because of that variable rate dividend and because it's so high, it looks off, an independent oil and gas company with a low debt rating. It has a wonderful position in the Permian Basin, which is this engine for them that they expect to grow, 5% annually for the next several years. And then they've got some other shale stuff that they're trying to test out, but for the most part, we're going to harvest this baby for cash. It's not the growth engine for us. Places like, if anybody remembers the names, it's like the Eagleford, the Niobrara Shale in the Powder River Basin, the Bakken, all the old hits of 2013, 2014. But
well, the areas that had minimal infrastructure, production costs were far higher because all of the innovations and that have been made, the improvements in the equipment that have been made over that past decade, you can produce that same barrel of oil for far less money today, get it to market more cheaply than you could at that time. And Devon has figured out how to make the most money out of that.
Yeah, and to pace it too. If there's barely any infrastructure there, why are you trying to grow in that particular area with 20% annually or something silly like that? No, let's just keep on doing what we're doing here. We've got access to infrastructure that works and we can keep it cheap and we can harvest it for cash. So that's what Devon's been doing. And with the variable rate dividend, it looks great. The thing that I get a little hung up with when it comes to these oil and gas cycles, I feel like 2 years from now, everyone's going to look at Devon and be like, you've been growing at 3 or 4% annually.
Time to grow again.
Where's your growth? We could see another decline in oil prices. And with a variable rate dividend, you're already tethered to movements of oil and gas when it comes to these businesses anyways, but you toss on a variable rate dividend and it's basically like taking that and giving it nitrous oxide on the engine. It's going to go one way or the other, almost in a more levered bet than it was before.
I want to hit on that for just a second here because I think it's important. There's a good chance you go to your favorite stock screener and you're going to see a dividend yield of about 9.5% for Devon Energy right now. And that's based on the dividends that it's paid over the past year. Here's the thing. Its most recent dividend was about 89 cents a share. It was paying dividends. It paid one dividend of its quarterly dividend last year, around $1.55 a share, round figures. Another one that was about $1.36 a share. So again, it's down to 89 cents a share because oil prices have come down. Its realized margins have come down as a result. So the real yield on that 89 cents a share, if you can assume that is the baseline that it pays over the next year, is more like 6.7%. So I think that's where the yield trap can come in if we go through a period of protracted weaker oil prices than we saw a year ago, which I think is probably likely. But it doesn't feel like we're going to go back to $120 a barrel anytime soon. People need to reset their expectations, I think, is the big one. Now, you talked about growth. We talked about the fact that Devon isn't your favorite, even though I think it's fairly reasonably priced, and investors with the right expectations understand where the real yield is likely to be. It's probably fine. But I know there's one you like a lot better, and that's Hess. Let's talk about Hess.
Hess, relatively similar in the sense where it's got a few positions. I would call them like the cash harvest positions, like Devon with some of its older shales. We're just going to harvest this for cash. Hess has the same, it's got some
stable business that it knows where the oil is. It knows where the replacement oil is for those new wells. And it's just got a process where it continues to develop and generate strong, steady cash flows.
Yeah, so it's got a few of those positions, but then its growth position is, I think, one of the more underappreciated aspects of independent oil and gas. because it tied its future to ExxonMobil several years ago on the exploration of Guyana, which just happens to be perhaps the greatest find of oil in the 21st century. The last estimate they had is this is combined, like across the entire field, not just Hess's share. After 31 exploratory wells that have hit on 6.6 million acres, by the way, that's 1,100 Gulf of Mexico blocks that we auction off. It's massive. They have found 11 billion barrels of oil recoverable, and they're not even done finding places. This thing is massive and it's cheap, and it is going to grow like wildfire because ExxonMobil sees it as one of the greatest low cost opportunities it has right now. It has sanctioned 5 development projects there already. 2 are up and running, and the break evens on these are anywhere between $25 and $35 a barrel. These are cheap. This is the closest thing to an ATM that any oil and gas company has out there right now.
And
Hess
Hess is
just
in a
happens to
perfect
have
position.
30% of the entire field. They have to spend a little bit more because they're liable for 30% of the development. So it doesn't look as good on the cash flow statement right now. But as these things grow out, it's looking incredible. From 2019, when they got their first one up and running, to 2026, they expect to go from basically 0 to 1 million barrels a day in the field, which is 300,000 barrels per day to Hess. Everything has come, thanks to being with ExxonMobil, everything's coming on time, under budget. You're bringing everything in the way you want it to happen. And I think 5 years from now, not only is it growing its production 10% annually, it's doing so by replacing older barrels that were more expensive with this super cheap Guyana oil. And I think management alone says with the replacement of its existing production with this Guyana field, they think that at $70 a barrel, their cash flow from operations is going to grow 25% annually out to 2027.
This may be a little bit of hyperbole, but I think number one, if you look at the difference in what Hess's stock price has done versus Devon Energy stock price over the past year, there's a reason why it's up 30% or so, while Devon's is down. The market generally knows what's going on with their future production. So we see that's baked in. But I think even with those gains, and again, like I said, this may sound like a little bit of hyperbole, but I think it's directionally accurate that Hess today is maybe more like buying Devon Energy 4 or 5 years ago in terms of the dividend and its ability to grow that payout and scaling up its production while also scaling down those costs and generating more free cash flow. And that's, again, the market sees that a little bit, but it still means that there is a pretty strong opportunity for patient investors who aren't necessarily trying to catch a big yield, but are looking for the best total returns. I think that's, to me, tell me if I'm right or wrong here, but that's where Hess is more enticing to you than Devon Energy.
Yeah, and like I said, it's offshore, so it takes longer to materialize than shale, and that's perhaps why it doesn't look as attractive right now in the moment. But 5 years from now, at what is projected, that looks awfully enticing.